Welcome to today's presentation, Wealth Management 101, where we'll be showing you some of the wealth management strategies that may help you build long-term wealth in today's uncertain markets. My name is Kevin Rucker, and I am joined by my partner, Seewer.
Hello.
We have been working together for almost 8 years and have almost a combined 40 years of experience in the financial services profession. We are here to assist our members with financial planning and investing. On this slide are some resources our team here at Alliant Retirement and Investment Services, shortened to ARIS, A-R-I-S, has. We offer several webinars on a monthly basis, a podcast, as well as blog posts and more on our website. This workshop is for informational purposes only. The factors we will be discussing today are just some of the things we consider when helping our members. So let's take a look at our agenda today and what we'll cover. First, we'll look at a market summary. Second, we'll look at strategies to help protect your lifestyle from rising costs. Then we'll move on to common investing pitfalls and conclude with key principles of investing and more. Steve?
Thanks, Kevin. This is a performance chart of the Standard & Poor's 500 index. It's comprised of the 500 largest companies in the United States. As you can see here, the S&P 500 has gradually climbed over this 13-year period. However, sometimes it has reversed and moved sharply lower. These swings up and down, or volatility, represent market risk. Investments in stocks have the potential to produce solid returns over time, but there will certainly be times when you lose value. That's why your time horizon is critical. The outcome of investing in stocks is unknown over short periods of time, but positive returns become much more likely over longer time horizons. Over long periods, equities tend to outperform alternative, low-risk conservative investments such as certificates of deposits or money markets. The 13-year period represented on this chart shows an appreciation of approximately 450%. And for much of this time, deposit accounts were paying historically low rates. The stock market has a tendency to move with the economic cycle. Economic growth and contraction is measured by GDP, gross domestic product. This is a measure of the economic output of the entire economy. Growth has varied widely from quarter to quarter over the past couple of years, as shown on this chart. And the chart on this page ends in the first quarter of 2023. In the second quarter, growth came in at 2.1%, and the third quarter clocked in at a very healthy 4.9%. So you can see there's a lot of ups and downs. So what will we see for economic growth or GDP in the new year? That's uncertain, because we appear to be at an inflection point in the economy. Perhaps inflation has been tamed and we are experiencing a soft landing, if you will, and we'll see economic growth continue into the new year. Or perhaps rates are too high and a recession will emerge. One key driver of GDP is the Federal Reserve, which has a dual mandate for full employment and stable prices. The main tool they employ is called monetary policy. You hear about this on the news when there are hikes or cuts to interest rates. Recently, the Fed has been hiking interest rates in an effort to tame inflation. These interest rate hikes take 6 to 9 months to filter through the economy, and we're still waiting to see how these hikes will affect GDP next year. Many analysts believe the Federal Reserve may start to cut interest rates later next year, which could result in a better economy moving forward.
Thank you, Steve, for the market summary there. That's a brief look at where we are now and with the stock market and both the economy. So let's move forward and discuss some of the key challenges we face when building a wealth management strategy. First, we'll talk about inflation. One way to think about inflation is by comparing your last car purchase, new or used, to the cost of your first home purchase, especially if you're in your 70s and 80s listening to this webinar. So let's take a look at this chart and how inflation has impacted the prices of critical items over the past 30 plus years. Just to step back and define inflation, it is the rate at which the average price level of a product or service in an economy increases over a period of time. It is also referred to as a decrease in purchasing power. So let's take a look here. In 1991, a single family home would have cost $97,000, a loaf of bread, 72 cents, and college education per year, $5,450. If we jump to 2001, that $97,000 home was then $147,800. A loaf of bread went up over $1. College education went up to $9,000. And if we look at this year, $501,000 is the average price for a home in the United States. A loaf of bread costs $1.95. Wonder Bread is the cheapest. College education, $28,000. And if you're thinking about your grandkids or your sons or daughters going to school, this is the price for a 4-year public out-of-state tuition, the average of it. So the proposed agenda for many retirees includes traveling, indulging in hobbies, and enjoying time with family. However, some may forget to factor in these rising prices or inflation, and it's very easy to do. The U.S. Bureau of Labor Statistics reported in May 2023 that inflation was 4% for the prior 12 months. But with many Americans living 25 or 30 years in retirement, it is critical to factor inflation into the financial strategies, and that's something that we always help with. So let's take a look at this chart here. We're going to look at the 2% annual inflation. If you're currently living on $50,000 a year in income, in 10 years, you will need $61,000 to replace that $50,000. In 20 years, you will need $74,000, and in 35 years, you will need $100,000. This shows what inflation does. Based on longevity, if you live 25, 30, or 35 years in retirement, we can see inflation do some damage to your purchasing power. And we have to always check if your portfolio will keep up with inflation, and will your withdrawals keep up with inflation as well. Here we're going to touch on capital gains and qualified dividends. This is another area that investors must consider. With respect to capital gains, taxpayers in the highest tax bracket are taxed at 20% on these, whereas those in the lower brackets pay either nothing or 15%. Long-term capital gains, defining them, those are realized gains that are assessed on investments that were sold or held for more than a year. In some circumstances, dividends can be taxed as ordinary income. So the same tax rates apply to qualified dividends. Non-qualified dividends, which are often referred to as ordinary dividends, are taxed at regular income tax rates. Taking a look here at longevity, which is one of the most important factors in preparing for a financially comfortable retirement, it's also a big unknown. Living longer creates a challenge for a retiree's portfolio. This slide here shows the probability of survival beyond age 65 for a couple. If you are a retired couple, both age 65, the likelihood that one of you will live 20 years in retirement is 84%. And there's a 63% chance that one of you could live to be 90 and spend 25 years in retirement. So if you only prepare for, say, 10, 15, or even 20 years, there's a good chance, statistically, you could come up short. For this reason, it is especially important to use investment strategies that try to balance a sustainable withdrawal rate with the appropriate measure of risk. Balancing these factors is crucial to help you create a strategy that's designed to ensure that you do not run out of money. Longevity can drastically affect how you take money out of your retirement savings. To show how important this is, if you withdraw just 1% more than your proposed withdrawal rate, you may not have enough money to continue the strategy for your lifetime. This is why accuracy is so critical, because the razor-thin margin between 1% too much and getting it right could have a very significant effect. Even looking at a portfolio that is 50% stocks, 40% bonds, and 10% treasury bills, like the one in this example on the slide, we notice that the impact of increasing the withdrawal rate from 1% up to 6%, and another 1% up to 7%, and so on, can affect your withdrawal strategy. So let's even imagine what could happen if this portfolio were entirely in cash or fixed income. The probability of success would be lower. We're using those equities to increase the longevity and protect against inflation over the long term. This is showing that if somebody is too conservative, their likelihood of running out of money is significantly greater because, as I stated, their portfolio can't keep up with their withdrawal rates. This is especially true when you add in the impact of inflation and longevity. We allocate to stocks to increase the growth potential of a portfolio to support the stated withdrawal rate. This, in effect, reduces both the risks of inflation and longevity. This is one of the key things we try to assist with, and it's why we recommend working with a qualified professional, because doing this on your own is difficult, and we have the instruments and the expertise here to assist. Steve, I'll pass it along to you for healthcare costs.
Oh, yeah, healthcare. So living longer may result in greater healthcare related spending. Medicare will cover many medical expenses, but it may not cover some of the most expensive services. If you look at this above, let's see, assisted living, nursing homes, home health aides, it's a lot of money. And keep in mind that these numbers represent national averages. Costs depend a lot on where you live and the kind of care you'll need. And as the need for care gets larger, more services, the costs go up step by step. Because healthcare costs have been rising faster than inflation for many years, it's critical to include long-term care intentions and solutions when doing your financial plan with your advisor.
Thank you, Steve. So moving on to common investing pitfalls here. With the 4 factors considered, there are many more. It's easy to see that effective wealth management involves more than just picking stocks. Some television commercials try to make you think it's so easy a baby can do it, but there's really a lot more involved in doing it right. So let's move on to the next section of our presentation here. One of the biggest challenges facing investors is the emotional roller coaster of investing. Letting erratic, short-term market movements create anxiety can push investors into making improper behavioral-based decisions. You can see here that investors go through a whole cycle of emotions depending on market movements. And market movements are represented here by the neon green line. At the beginning, the investor may be confident, they're making money, everything's great. At the top of the market, they become euphoric, thinking they can quit their day job and do investing full time, seeing all the money they're making. As the market switches direction and goes downwards, they become a little nervous. They don't really know what's going on. They're asking what happened. Then they become desperate, thinking there's no point in selling now. They've lost too much. So they're really questioning when to get out of the market or if they should at all. Then when the market bottoms at the trough, they become defeated, saying, there go my dreams of a comfortable retirement. And at that point, it's actually the potential opportunity to make money. So a lot of investors will get out of the market at the time when they probably should stay in the market. And then if when the market turns up, they're becoming hopeful, thinking things seem like they're turning around. Steve, pass it on to you.
Thanks, Kevin. When it comes to investing, emotional reactions can be costly. The white bar on this page reflects the average investor's annualized earnings over the past decade, roughly half of what the S&P 500 returned over the same period. Why do you think investors earn significantly less than the stock market? Well, most investors don't have 100% of their portfolio invested in stocks, so that explains part of the difference. But emotional decision-making explains some of the gap as well. Money is emotional, and we are hardwired to react to danger. You may be familiar with the evolutionary adaptation called fight or flight. Essentially, 200,000 years ago, we needed to be hypervigilant to danger, or we could end up as dinner for a 500-pound saber-toothed tiger. Today, we need not fear an attack from Mr. Whiskers, but violent swings in the value of our investments can trigger that same hardwired acute stress response. And driven by fear, some investors sell at the worst time. The proven winning strategy is to remain invested, weather the storm, rather than attempting to time the market by selling when markets turn lower. Patience is a virtue with investing. Try to tame that caveman response. Take a deep breath and remember that there has never been a time when the stock market has declined and not eventually turned higher to achieve new record highs. A patient attitude coupled with risk-appropriate portfolio diversification will eventually lead to investment success. Here we've got a bunch of disclosures about the index and so forth. We're happy to send this to you if you want to see it in more detail. Kevin.
Thank you, Steve. So during times of volatility, investors may seek the safety of conservative investments or may even decide to get out of the market entirely. It's perfectly natural to want to avoid losses and protect your assets, but abandoning your long-term investing approach in the face of short-term volatility can potentially slow your progress toward pursuing your goals and make the road to recovery longer. This chart illustrates just how difficult it can be for a portfolio to recover after experiencing a downturn. Let's take a look at an example when a portfolio is down 30%. The total return needed to break even is 43%. The number of years to break even, and we have to assume different risk returns here. Assuming a return of 3% would be 12.1 years, 5% return 7.3, 8% 4.6, 10 3.7, and if you're investing aggressively with a 12% return, 3.1%. But of course, if you're going to stick to a long-term investment strategy, it is vital that you incorporate some key principles. Let's move along to those principles here. Nothing we discuss in this section can guarantee success or protection in times of loss, but experience shows that these key principles can have a strong influence on your long-term financial health. Experience has taught us that there are 4 basic ways to address risk. The first would be ignore, and we're going to use the example of driving, which a lot of individuals do. If you're managing the risk of driving, you would say, I'm going to ignore all the risk because if I crash, I'll just buy a new car. Hopefully you don't injure yourself. Avoiding risk would be, I won't drive at all. Managing the risk will be, I'll drive defensively with my hands at 10 and 2. Transferring the risk will be, I'll buy car insurance or just Uber. When it comes to investing, decisions on whether to ignore, avoid, manage, or transfer risk will vary from person to person. Our job is to educate you about your options and help you make the right decision. Steve?
All right, so let's talk about risk tolerance. It's one of the most important elements of financial planning with a client. Which one of these describes you? You have trouble dealing with any downturn and want consistent returns even if they're low. That's low risk tolerance. Large performance swings may keep you up at night, but a moderate amount of fluctuation is okay with you. That's medium. Even large performance swings won't derail your investment strategy. You're steady as a rock. That's high risk tolerance. And beyond that, there's speculative, which we really don't deal with at LPL or Alliant Retirement and Investment. So think about your own risk tolerance. As I said earlier, it's the most important element of working with our clients. And it's why when we're building portfolios, we go through an in-depth, comprehensive risk assessment. We can talk to you more about that. If you want to hear more about it, just shoot us a message in the comments. And here we're going to talk about a concept called asset allocation. Selecting a suitable combination of investments to meet your objective is of paramount importance. Multiple studies have shown that asset allocation is the primary factor that influences both volatility and the return of a portfolio. And a landmark study showed that 88% of portfolio performance over time could be attributed to the mixture of the assets in the portfolio. The bottom line is that it's not about picking winners or jumping in and out of the markets that determine long-term investment outcomes. It's just picking the right mix of investments for your risk tolerance and personal situation. It's just the ratio between the investments that make up the portfolio that's most important. And then that again goes back to risk tolerance. Kevin.
Thank you, Steve. Total wealth management doesn't leave out any pieces. So as we go about managing wealth with our clients, there are many strategies that we employ. You can see here a mix. Some of them will be insurance, diversification within asset classes, as we spoke, looking for tax efficient investments, and diversification across different asset classes. One thing we say is concentration helps to create wealth, like if you invest in just Apple, but diversification helps to preserve wealth. So we'd like to talk with you about that further, and the mix of strategies that we employ. Everyone's investment needs are unique, as we understand, and we work hard to structure a personal strategy for each of those needs. Here you can see what is commonly referred to as the bucket strategy. Imagine a portfolio that has 5 buckets. Bucket number 1 contains the money we put away for the income needs of you and your family for the next 12 months. Bucket number 2 contains the income that you will need for years 2 and 3. Bucket number 3 contains the income that you are going to need for years 4 through 6. Bucket number 4 contains the income that you will need for years 7 through 10. And bucket number 5, the final bucket, contains the money that you will need for years 11 and beyond. We need to manage the money that you will need for the next 12 months differently than the money you will need for years 11 for the following years. The money in the first bucket that we put away for the first 12 months is invested in cash and cash equivalents, very conservative investments to meet your income needs. The second bucket and third buckets are where you can start becoming a bit less conservative and taking more risk. As we move towards the right, we, as you can see here, move to more risky investments to get you more growth potential and reduce those risks of longevity and inflation. And the riskiest, so the most stock-heavy allocation, is in the fifth bucket. So what we accomplish by this bucket strategy is assessing your short, medium, and long-term needs, as well as spreading out the money into different instruments with the proper amount of risk and liquidity. In this way, we strive to ensure that you are prepared for the various future phases of life. So that concludes the content for our presentation. We are happy here to provide you with an obligation-free complimentary assessment of your portfolio and help answer any personal questions you have. And we will now take the time to answer any questions and answers of general questions that came through during the presentation. Thank you for attending.